For those of us tracking the leisure and hospitality sector, wading through company financials can feel a bit much sometimes, right? Even with all the data.
Definitely. There's a lot to sift through.
So today, we're going to cut through that noise. We're pulling out what really matter from Mahindra Holidays and Resorts India Ltd's latest Q1 results. That's for the quarter ending June 30, 2025.
Club Mahindra, as most people probably know them.
Exactly, Club Mahindra.
Yeah.
We've got the official press release, the outcome from their board meeting, even their investor presentation. So it's like a proper deep dive look.
Right. And our mission here,
Yeah.
for you listening, is to pull out the key takeaways from all this. Not just the numbers, but what they actually mean for, a major player like Mahindra Holidays and the whole travel scene in India.
So what really stands out? In a sector that's always changing, what makes for a standout quarter?
That's the key question, isn't it?
Okay, so let's unpack this then. What's the absolute top-line headline, the big story from this quarter for Mahindra Holidays?
Well, the headline is definitely profit growth. I mean, significant profit growth. If you look just at the standalone results, mostly their India business, profit after tax, PRKT jumped. Get this, 69% year on year.
69%. Wow.
Yeah. And even the consolidated picture, which includes their overseas stuff, PIT was still up a healthy 18%. What's really interesting here is, despite all the talk of economic headwinds, especially outside India, they've somehow managed this really strong bottom line growth.
That 69% jump, that's not just noise. It really points to some serious operational strength, wouldn't you say?
Absolutely. It suggests their domestic model is incredibly resilient, maybe even, a bit of a defensive quality in a shaky global market.
Interesting angle. Is this growth as solid as it looks? Any caveats we should keep in mind? And just for context, remind us, this is the company with, 126 resorts?
Yeah, 126 resorts, India and abroad. Inventory is almost 5,800 keys, mostly through that vacation ownership model they're known for.
Right.
And to your question, yes, the growth looks pretty robust, especially domestically. Let's break down those standalone numbers, because that's where the action is.
Okay.
Total income for Q1 FY26, it went up 7% year on year. But RAS 410.6 crore. But the real story, I think, is efficiency.
How so?
Their operational profit, EBITDA earnings, before interest, taxes, depreciation, and amortization, that surged a huge 42%, up to RAS 160.9 crore.
42%, okay.
And like we said, that flows straight down to that massive 69% jump in net profit, the PAT, that hit RAS 76.2 crore.
And that means their margins improved significantly too.
Massively. The PT margin expanded by 680 basis points. That's like a 6.8 percentage point improvement. It really shows they're squeezing more profit out of their revenue, managing costs better.
That profit surge is really something. So what levers did they actually pull, operationally speaking? Was it just cutting costs, better pricing?
A key part was definitely resort revenue itself. That grew 10% year on year, hit Rs 114 crore. And they did this while keeping resort occupancy really strong, about 85.4%. Even though they've actually added more rooms. So they're filling their resorts effectively.
Now let's talk memberships. This part caught my eye. The average revenue per member went way up, but the total sales value and number of new members actually dropped. How does that work?
Yeah, that's a really sharp observation. It seems counterintuitive at first, right?
A little bit, yeah.
The average unit realization, AUR, for memberships, it soared 69% year on year. That's up to Rs 8.3 lakh per new membership unit on average.
Huge jump.
Huge. But as you said, the total membership sales value was down 30% to Rs 127 crore, and they added fewer new members, down 59% to just over 1,500.
So what's the strategy there?
Well, it looks like a very deliberate choice. Management, specifically the CEO Manoj Bhat, talk about their strategy of selective member addition while pursuing premiumization.
Ah, okay. Quality over quantity.
Exactly. They're focusing on getting higher value from each member rather than just signing up as many people as possible. Premiumization.
Makes sense.
And another interesting point, 65% of those new members came through referrals or digital channels. That's up from 56% last year. Suggests they're getting more efficient at acquiring customers too, perhaps cheaper.
Right. So profitability looks good. Strategy seems clear. What about their financial foundation, cash on hand, debt?
Very strong position there. As of the end of June 2025, their cash was sitting at Rs 1,576 crore. That's up 10% from last year.
Healthy buffer.
Definitely. And they also reported deferred revenue of Rs 5,755 crore, which, given their model, is basically future income locked in. Money received for holidays yet to be taken.
That's been great visibility.
Huge visibility. And importantly, on a standalone basis, the company is still debt-free, which gives them a ton of flexibility.
Okay, so with that domestic strength and solid financials, what are they doing about expanding, adding more resorts?
They're definitely expanding. They've currently got that inventory of just under 5,800 keys across the 126 resorts.
Right.
And they have 5 projects underway right now. Some are new builds, greenfield, others are expansions, brownfield.
Where are these happening?
Well, the big new ones include 236 keys in Ganpatapul, that's in Maharashtra, and 157 keys in Theog, Himachal Pradesh.
Significant additions.
Yeah. And then expansions in places like Kandakat, also Himachal, Treehouse in Jaipur, and Pondicherry Phase 2, actually. They've just started another new expansion project in Pondicherry, too.
That sounds pretty ambitious. What's the big goal here? And are there risks in growing that fast, like finding good spots, funding it all, keeping quality up?
The big goal, the aspiration management has stated, is 10,000 rooms by FY30.
10,000. Wow.
It's aggressive for sure. It clearly aligns with the booming demand they see in India for leisure travel.
And the risks.
Well, execution is always a risk. Construction delays, quality control, hiring staff. But that strong cash position and zero debt helps a lot with the funding side. Strategically, it's about grabbing market share while the market's hot. And they seem confident in their model, their member-to-room ratio. It keeps improving, meaning they're getting better at serving more members with the rooms they have. Better asset utilization as they grow.
But hitting 10,000 rooms, how do they make sure the experience doesn't suffer? That premium feel seems key to their higher AUR strategy. Is there a danger of stretching too thin?
That's definitely the balancing act. But quality seems to remain a major focus. I mean, 14 of their resorts just got the TripAdvisor Traveler's Choice Award.
Okay, that's a good sign.
It suggests they are managing to maintain standards even while pushing for scale. It's something to watch for sure, but the signs are positive for now.
All right, let's switch continents. What about their European arm, Holiday Club Resorts Oy, or HCR in Finland? How did that part of the business do?
Right, HCR. They have 33 properties, timeshares, spa resorts, mainly in Finland, but also Sweden and Spain. Performance there improved this quarter, even though they called it a weak seasonal quarter for Europe.
Improved how? Still losing money.
Yeah, still a loss, but smaller. The improvement came mainly from growth in their spa and rental revenues. Revenue overall was up 4% year-on-year to 31.4 million euros, and the PAT loss narrowed from 3.6 million euros last year to 3.2 million euros this year.
So tough market, but moving in the right direction, narrowing the loss. How did this feed into the overall group results, the consolidated picture?
Well, the consolidated profits definitely took a hit from currency movements. Adverse currency movements, as they put it. Mostly the euro moving against the rupee.
Ah, the Forex impact.
Exactly. But despite that headwind, which was significant, the consolidated PAT still grew 18% year-on-year.
Still impressive growth.
And here's the kicker: if you strip out that Forex impact, the consolidated PAT was actually 13 times higher than the previous year.
13 times. Okay, that really shows the underlying business is performing strongly.
It really does. It highlights that operational strength across the board, even when external financial factors like currency are working against them.
And I think I saw something about another acquisition in Europe.
Yes. Just after the quarter ended, on July 3rd, HCR signed a deal to buy 100% of another Finnish company, Kistanainen Kiinteistö Oy Salastar.
Interesting. So they're still investing and expanding strategically in Europe, too.
Seems like it. Suggests they see long-term potential there, despite the current seasonality or economic pressures.
Okay, so pulling it all together then, the consolidated view.
Right, the big picture, consolidated. Total income, RS 740.2 crore, that's up 8% year-on-year. EBITDA, RS 161.2 crore, up 16% year-on-year. And remember, achieved despite those currency headwinds. Reinforces that solid operational base.
Got it. Now, stepping away from the pure financials for a moment, I noticed a couple of, let's say, corporate governance type items in the board meeting notes. First, something about an order from the NFRA, the National Financial Reporting Authority. What's that about, and what does it tell us?
Yeah, that's an important point on transparency and accountability. The NFRA, which is India's independent audit regulator, had issued an order back in March 2023. It had observations about how Mahindra Holidays identified its operating segments and how it recognized revenue.
So regulatory scrutiny on their accounting.
Essentially, yes, which we're seeing more of across the board in India. But Mahindra Holidays stated in their notes for this quarter, as of June 30th, that based on their assessment, their current accounting policies are fully compliant with Indian accounting standards.
And the auditors agree.
Their auditors, BSR and Co., did a limited review. They found no material misstatement and confirmed they'd verified the company's review and reported back to the NFRA. So it looks like they've addressed the observations and are engaging proactively with the regulator, just on commitment to compliance, which is generally good for investor trust.
Okay, that's reassuring. And there was also a change in key managerial personnel, a retirement, and a new appointment.
That's right. Mr. Don Raj Mulkey, the company's secretary and compliance officer, is retiring at the end of October this year. Standard superannuation.
And the replacement.
Mrs. Mansi Lahiri has been appointed company secretary designate from August 1st and will take over fully from November 1st. She's coming over from Mahindra and Mahindra Financial Services, where she was VP of Secretarial. Brings over 17 years of experience.
So looks like a smooth, planned transition in a pretty crucial role.
Exactly. Ensures continuity and brings in experienced leadership for that legal secretarial compliance side.
All right, let's zoom back out. Final piece. Connecting all these company specifics to the wider market, the investor presentation really painted India as being in a sweet spot right now, especially for leisure. What are the big trends supporting Mahindra Holidays' strategy?
Well, the data they presented and wider market data strongly backs that up. India's projected growth is huge, aiming to be the third largest economy by 2030. You've got consumer spending, lifestyle shifts, e-commerce all booming.
And discretionary spending specifically.
Yeah.
The money people have for things like holidays.
Expected to grow incredibly fast, something like 19% annually between 2022 and 2030. Plus, household incomes are shifting upwards, more people in those upper middle and high income brackets.
Which is the target market for leisure and experiences.
Absolutely. It means a bigger pool of consumers with more money and, crucially, a growing desire to spend it on experiences rather than just things.
So basically a demographic wave lifting the entire travel and leisure boat.
Pretty much. The hospitality sector is already seeing demand run ahead of supply, particularly for quality branded places in leisure spots.
And specific trends within travel?
Yeah, you've got the continued rise in domestic leisure trips, business travel and events, MIC, they call it, meetings, incentives, conferences, exhibitions, that's coming back strong. Weddings are big business. Even spiritual tourism is booming.
Lots of drivers.
Definitely. And then there's the government's push aiming for a $1 trillion tourism economy by 2047, targeting 100 million international visitors eventually. It all paints a very positive long-term picture.
And Mahindra Holidays' strategy seems to fit right into that picture.
It really does. Their expansion plan, that goal of 10,000 rooms, their focus on member experiences, the premiumization strategy, it all seems very well timed and aligned with these powerful macro tailwinds.
Okay, that was a really thorough deep dive. We've covered a lot from that strong standalone profit jump driven by resort performance and that premium membership strategy.
Right, and seeing how their European side is showing resilience even with currency issues.
To connecting it all back to the bigger picture of India's booming tourism market, their expansion plans, how they're handling regulations, leadership changes.
Yeah, and maintaining that strong financial footing throughout. It's quite a story this quarter.
It really is. So for you, our listener, here's something to think about. Mahindra Holidays has this unique vacation ownership model. You pay up front, you get future holidays, they get deferred revenue. How might that model, with its kind of built-in predictability and focus on keeping members engaged long-term, actually be more resilient or maybe even give them an edge in this fast-changing leisure market compared to, say, traditional hotels that just rely on selling rooms night after night, something to mull over?